Ladies and gentlemen, good afternoon and good morning. On behalf of the C-suite, welcome and thank you for taking time out of your busy schedules. At our 2023 year-end results in February, we made a commitment to focus on our balance sheet. Today, I hope you will recognize the tremendous effort from the Sibanye-Stillwater team in doing just that. And hence the theme of the H1 2024 presentation is reflected in the presentation title, and let me read it. It says, delivering on our commitment to strengthen the balance sheet while also increasing liquidity. Please take note of our safe harbor statement. The agenda for today includes a brief strategic context that'll be led by myself, and essentially it all starts and ends in the market, and you will see what I'm referring to when we get into that. I will also cover the salient features for the first half of 2024. Charles Cater, our CFO, will then complete the financial review, after which he will hand over to our chief regional officers, who will each cover their regions. We have Richard Stewart doing the South African region. We have Mika Seitovarita doing the European region. Charles Carter will do the US region. And Robert van Niekerk, who's also our chief technical and innovation officer, is also the chief regional officer for Australia, and he will cover the Australian region. So our 3D strategy is well known to the market. There's just a few points that I want to make, and I'm not going to go through all the detail on the slide. Our board, together with the executive, have recently been through an extensive strategic review, and we remain confident that our strategy is relevant, and delivering on shared value remains a keen focus for us. Our focus, however, remains on the strategic essentials, especially through the current commodity price cycle. There are two other things that I want to mention that I think are relevant to the discussion today. Despite the noise that is creeping into the debate regarding the relevance of ESG, we as a company remain steadfast in our view regarding the importance and the relevance of ESG. We believe it's a good business practice, and it will remain embedded as the way we do business. I also read much around the issues of diversity, with suggestions that if you go woke, you go broke. And again, I think that's such nonsense. We will continue to drive inclusivity, diversity, and belonging, as we believe it creates a competitive advantage for a company like ourselves. Just moving on to the strategic context, I want to say that in terms of the metals that we have exposure to, understanding mobility, or probably more particularly the evolution of mobility, is important to understanding how the green metals could well be used in the future. I think it's important to note that electric powertrains are technologically smart and will certainly be the powertrains of the future. Within a short period of time, the issues around constraints and negative views of battery electric vehicles will be addressed, and there is no doubt in my mind that battery electric vehicles will remain a very significant part of the future global car pool. I think it's also important to note that legislation on its own cannot drive what policy is being implemented in many countries. Consumer preferences and societal patterns will also influence the market and the way cars and powertrains are utilized. I think as such, and it's well noted on this slide, powertrains will be an evolving mix of technologies, and it will include internal combustion engines for a long period of time still, hybrids, fuel cells, and pure battery electric vehicles. Hydrogen will certainly play a role in powertrains, both in fuel cells as well as in direct combustion engines. Synthetic fuels have the potential to extend the era of vehicles with pure internal combustion engines. Our views in this regard have been very consistent, and it's amazing to me how the pendulum swings from extreme positivity of battery electric vehicles to negative views, and the same regarding internal combustion engines and PGMs. I think the bottom line is that you need to be on the right side of technology, and we have, I believe, good exposure to all the evolving technologies from our metals point of view. We will now move on to just talk a little bit about the markets, specifically PGMs and lithium. Within our C-suite, we have dedicated commodity champions whose responsibility it is to stay abreast of market trends and developments that relate to their metals and to develop our house views. Richard Stewart is our commodity champion for PGMs, and Mika Setavarita is our commodity champion for battery metals. So at this point, I'm going to hand over to Richard to take us through our house view on PGMs, more specifically platinum and palladium. And after that, I'll ask Richard to hand over directly to Mika to cover the lithium market. Thank you, Richard. Over to you.
Thank you very much, Neil, and good afternoon, ladies and gentlemen. Discussing commodity markets at the moment, I guess many are asking many questions about where these markets are going, and PGMs is certainly no exception. The way we look at the markets at the moment to drive our business is really across three different time periods. So we look at a short term, generally less than 2 years. Tactically, how do we respond to the current market? We look at a medium term, generally out to about 10 years, where I think we have some confidence in terms of the way we forecast, and then slightly more speculative beyond 10 years. So certainly our view in terms of the short term and what we're seeing is that there has been a distinct dislocation between the fundamentals that we see. Fundamentally, we believe the 3E metals, PGMs, are very much in deficit, and the price trends that we've seen, which of course have been falling a lot faster and a lot further than I think many imagined. Of course, the question is, why is that the case? We don't see a silver bullet or a single reason for this. It really has been a coming together of multitudes of factors. We have mentioned in the past things like destocking. Several OEMs did build up stocks post-COVID, and that has been coming out over the last few years, although we do think that is declining. We have also seen in the market some significant disruptions to supply chains and changes to supply chains, in particular, a lot more Russian metal finding its way into China. And then we have some in the PGM market, probably about 80% of the metal trades as physical metal under long-term supply agreements, with a very small portion trading in the spot market that ultimately sets the price. And of course, when you have disruptions to supply chains and take some spot buyers out of the market, that does have a significant impact. Combine all of that with some negative sentiment around global macroeconomics, BEV growth rates, And essentially what you end up is a highly dislocated market between, let's call it paper trading, and ultimate fundamental or physical trading. When we've seen this in the past, it does tend to come together again. And the more extended the dislocation, the more severe the correction. So our view is that for the short term, we do still expect volatility, but ultimately we think the fundamentals will come through, and therefore there is risk upside for some very rapid reactions and price appreciation as markets continue to tighten. But certainly we are planning for a volatile short-term period. In terms of the medium term, we have in fact, I think, become more robust given what we've seen happening over the last 18 months. Our view on the markets has not materially changed, but because of the lower price environments we've seen, the primary supply coming out of particularly South Africa and North America has in fact declined more than what we originally forecast, and we don't see much growth coming out of Russian supply. Similarly, secondary supply we think is going to remain constrained because of both margin pressure as well as supply chain disruptions. And as we've seen, demand in terms of the rates of which BEVs are growing, and they will continue to grow, but just that rate has been moderated. And we think that gap will be filled by ICE hybrid vehicles, which is good for both PGMs and battery metals. And taking a combination of that supply pressure and demand moderation in the medium term, we actually think the PGM market remains pretty robust, a view that we have held for an extended period of time. Over the long term, it does become a bit more speculative, and we do see structural changes occurring. Today, PGM demand, about 2/3 of it is underpinned by auto catalysts, and we see that declining to about 50% out to 2040. The difference in demand will be made up by industrial applications, a significant portion of which will be associated with the hydrogen economy. But of course, there are still many factors that we need to understand how these technologies develop and are taken up before we can get confidence in that forecast. And that drives our long-term market development strategy around securing sticky industrial applications to replace largely auto catalyst demand for the decades to come. So just looking at our overall view of that market, we do model it as a 2E basket, being platinum and palladium, given that they are substitutable. And what you can see in the white bars is almost an average of various market research houses, which would suggest that we still have deficits up to about 2027 and then moving into surpluses. For the factors that we've mentioned above, the supply constraints, as well as a moderation in terms of battery electric vehicle penetration, we in fact see deficits for the balance of this decade, only then moving into slight surpluses early in the following decade. So overall, a robust view for the medium term for PGMs. I'll now hand over to Mika, who will discuss lithium markets. Thank you.
Thank you, Richard. A few words about lithium supply and demand balance and the outlook, how we see that. First of all, behind there is obviously the growth of the electric vehicles. Many of us have revised downwards the forecasts and the volumes of the EVs, and so have we. Even in the downward scenario, though, we believe that during the next 5 years, by 2030, the volumes are going to be double against today's volumes. This is obviously something that is going to impact the lithium demand a lot. So despite of the short-term surplus in the market, we see a very strong outlook long-term for lithium demand. Meaning that actually during the next 5 years, consequently, we believe that lithium demand is going to double as well. It is also to be noted that the deficit starts 26, 27, which is a perfect timing for our Keliber project when we start the commissioning with our own ore. Over to you, Neil.
Thank you, Mika and Richard. Let's now move ahead with the salient features for the first half of 2024. So the picture on the right-hand side of the slide is actually the first slide in the year-end presentation, which was delivered in February of this year. As I mentioned in my introduction today, we committed at that point in time to focusing on our balance sheet, and the piggy bank was also used to reflect the cost savings we intended to achieve from the large amounts of operational restructuring that we intended undertaking and had undertaken to preserve our margins through this lower price commodity downturn. I am particularly pleased with what we have achieved to date on both of these. Richard will cover the cost benefits of our operational restructuring in his section, but let me start with the impact that we've made on the balance sheet. So I'm very pleased to advise that we've increased our balance sheet strength and liquidity by more than 25 billion rand, or $1.4 billion US dollars. And we will in the following slide show you how that amount has been calculated. But first of all, what did we do? And the H1 balance sheet initiatives are listed there, and I intend to go through them in some detail. We announced the uplifted agreements we had on our covenants. The debt covenants have been uplifted to 3.5 times until June 2025 and 3 times until December 2025. We have a currency geared collar that we've implemented at our South African PGM operations to protect the margin in a strengthening ZAR environment. That was done on the basis that we could see the potential of an improving climate in South Africa, and I dare say the appointment of a government of national unity is a first very important step in that, and we believe the rand will continue to strengthen, and that is a protection on the downside. Our convertible bond derivative, was reclassified as equity following the Sibanye-Stillwater shareholder approval. The 6 billion rand RCF refinancing and upsizing was completed. We entered into post June 30, in fact in August, a 1.8 billion rand gold prepay that is currently being implemented. The Calibre Lithium project was separately financed to the tune of 500 million euros through a green financing. And then, of course, operationally, we benefited from improved adjusted free cash flow compared to the second half of 2023, following some of the operational restructuring starting to impact. Very pleasingly, and I've highlighted it in dark black, is that our net debt to adjusted EBITDA is currently at 1.43 times. And I want to point out that does not include the gold prepay, and I will give you a pro forma indication of what that looks like with the gold prepay. As I say, a very pleasing result, and certainly the expectations, I think, of the sell side analysts that we would be resorting to some form of deeply discounted rights offer must now be moot. So I did indicate that in the following slide, which you can now see, we would indicate what we have completed and the value ascribed to each one of those initiatives. The covenant uplift gives us a turn of 1 times, and assuming our adjusted EBITDA for a year is about 13 billion at this point in time, that's a 13 billion benefit. The currency hedging and geared collar is on the slide, the prepay, the refinancing, the green loan, and all of that totals up to just over 25 billion rand, or as I said, $1.4 billion US. What we still have in the pipeline is another 600 to 700 million US of streams and other prepays that we are working on. So we are looking forward to an estimated pro forma total of increasing the balance sheet strength and liquidity in excess of 36 billion rand, or about $2 billion US. And as I've said, any suggestions that we're going to have to revert to equity to strengthen our balance sheet must be somewhat moot now. There is one area where we still have some work to do. The polygons on the left indicate a number of ticks, areas where we've completed restructuring, or in Sandoval's case, we've terminated what we believe was an onerous contract. The covenant uplifts, the convertible bond, and the gold prepay are all done. The one area where we're still plagued with losses in our business is in the US. And with the announcement today, we have initiated what I believe will hopefully be the last phase of restructuring. And I think it's quite material and quite significant. So let me talk you through it. And when Charles covers the US region, he will provide more detail. But we are now entering a final phase where we will be restructuring the US business for a 2E PGM basket price below $1,000 per 2E ounce. How are we going to do that? We are terminating high-cost production of about 200,000 2E ounces from the US PGM operations. Stillwater mine will be put on care and maintenance. We will increase production slightly from our higher grade Stillwater East operations, which has lower cost infrastructure and more efficient infrastructure. We will also reduce production from East Boulder, and that will essentially improve their cost performance, but also defer expansion capital. Unfortunately, it does result in a further headcount reduction of approximately 800 employees and contractors. The net result is that we will still ensure sufficient scale of operation to maintain our very important recycling operations and to leverage off the recent Reldan acquisition. Probably more importantly, with a high quality ore body of this nature, we retain mining optionality for a higher 2E basket price environment. We certainly did look at putting the entire business on care and maintenance. That is a much higher cost option than what we have set out here, but I will leave it to Charles to talk us through that detail. As we always do, we are sharing with you our gearing, and this is a graph of adjusted EBITDA and of course net debt to adjusted EBITDA multiples reflected in the red dotted line. Pleasingly, and as I've said, without the gold prepay, our net debt to adjusted EBITDA as of 30th June comes out at 1.43 times. If we include the gold prepay, that number is actually 1.29. You would remember that we have said around 1 times is a net debt to adjusted EBITDA multiple that we are comfortable with. So again, I think very pleasing from our point of view under these circumstances to be operating at those sort of levels. So we've covered protecting the balance sheet. Let's now move on to some of the other salient features in terms of embedding ESG in our business. Very pleasingly, we are achieving record group safety performance. And I will leave it to Richard to talk in more detail about that. We're advancing our green metal strategy and growing our secondary and urban mining platform that is inherently environmentally friendly and responsible. Our journey to net zero continues with 407 megawatts of renewable energy PPAs projects under construction. And in addressing the Marikana massacre, which was not during our ownership of those assets, we have implemented the Marikana renewal process, and that is resulting in significant collaboration from those impacted and affected communities, and it's resulting in positive change. And I'm sure you may have seen some of the media commentary on that at the anniversary. In terms of delivering on operational improvements and operational sustainability, very pleasingly, the South African PGM business had a solid operational performance, benefiting from the proactive restructuring done earlier this year. Our gold business had a disappointing operational performance, mainly due to seismicity, and of course any restructuring is disruptive, but we certainly look forward to improved performance for the second half of 2024. Our US PGM business had a solid operational first half and continued to build on the good results of the restructuring late last year, but because of low palladium prices, it remains loss-making, and hence the restructuring that I referred to in the previous slide. Our US recycling business generates positive earnings and cash flow. Sandouville also generated an improved performance, but of course, because of the structural change in the nickel market and the low nickel prices, we brought forward the conclusion or the termination of the nickel supply contract that we had with Boliden. The Keliber lithium project continues well and in line with our expectations. And pleasingly, the Century zinc retreatment operation is on track for a profitable 2024. I'm not going to go through all the financial numbers. Charles will cover that in the financial review, but just to say, clearly earnings and cash flow impacted by a significant decline in the PGM basket price. We made a basic loss of 7.5 billion rand. We did have headline earnings of 137 million. There was a 7.5 billion rand impairment of the US PGM operations, and you can see that basic loss is basically the impairment. Our gross debt of 34.2 billion is actually 9% lower than at 31 December 2023. And we ended up with cash and cash equivalents of just over 15.5 billion rand. I would like to just talk a little bit about unlocking the latent value potential as the last slide in this section. There are a number of areas where there is significant value that we are in the process of unlocking. Our South African uranium assets and strategy has good direction, especially with the appointment of Greg Cochran to lead this part of our business. In terms of the Cook Tailings resource, we've completed a review. We will complete a further feasibility study in 2025. I think important to note that it's near to midterm potential from a uranium production point of view, plus it has the benefit of gold byproduct credits. It's an opportunity to use this asset to build a uranium business, leveraging off Cook's low technical risk development. The Beiser uranium mine also has significant U3O8 resources, and there's significant potential to unlock value through a partnership or sale to third parties, where we are in discussion. In terms of the Century operations, very pleasingly, we are now starting to assess opportunities to leverage the existing infrastructure, which is the port, the concentrator, the pipeline, by looking at phosphate deposits within that region. We have a number of our own phosphate deposits, but there's the region is well endowed with some very good phosphate deposits. So that will be receiving some attention, and we look forward to providing you with more information in due course. We completed the Class 3 feasibility study on Mount Lyell during the first half of this year, and we have decided that it warrants taking the feasibility study to a Class 2 estimate, and we expect that being completed in 2025. Rhyolite Ridge, there's a decision pending. Once we have the environmental permit record of decision and the Class 2 feasibility results. So we look forward to receiving those and applying our minds. Reldan has very significant future recycling growth potential in Mexico and India, and it's not just through electronic waste. This business is being very complementary to our AutoCat recycling business in Columbus. So I would like to, at this point, hand over to Charl Keyter to take us through the financial reviews. Thanks, Charl. Over to you.
Thank you, Neil. Good morning and good afternoon to all participants. Starting with the financial performance for half 1 2024, revenue was down 9% due to significantly lower PGM prices. Although production volumes were up at the SA and US PGM operations, the 4E and 2E basket price were down 28% respectively, and the 3E basket price was down 53% for our US PGM recycling operation. Pleasingly, the gold price was up 18%, but this was almost fully offset by lower volumes. Cost of sales increased period over period, but this half year includes 6 months for the new Century operations compared to 4 months in the previous period, and it includes the newly acquired Reldan operation from 15 March 2024. Normalizing for the Reldan acquisition, costs in absolute terms only went up by 2%. Adjusted EBITDA came in at just over 6.6 billion rand, almost half the number for the same period in the previous year, and this was predominantly driven by lower revenues. During this period, we also reperformed our impairment assessment, and based on consensus lower future palladium prices, an impairment of $400 million was recognized at our US PGM operations. The loss for the period was 7.2 billion rand, but after backing out the US impairment and the associated taxes, the profit would have been approximately 550 million rand. In line with our dividend policy, no dividend was declared. This slide shows our debt maturities and liquidity. Net debt at the end of the period was 18.7 billion rand, and the repayment profile following the refinancing of our Rand revolving credit facility remains very manageable, with the 2026 bonds being our first significant maturity. Liquidity headroom is just under 40 billion rand, which is roughly 2.5 times our requirement, and that is having 2 months of operational and capital expenditure in available headroom. Liquidity headroom was extended through the refinancing and upsizing of the Rand revolving credit facility, the conclusion of the Keliber 500 million euro green financing, and the execution of the 1.8 billion Rand gold prepay. Just a few words on the cyber attack that we experienced post half 1 2024, and also the reason for the delay in results. In July, we experienced a cyber attack that impacted our global ICT systems. On discovery, the group ICT team acted swiftly to isolate our networks and systems across all regions and business units. The operational impact was limited, but I think very importantly, safety of our employees were prioritized in all instances. The biggest impact was at our US metallurgical complex, impacting smelting and recycling processes that resulted in increased stockpiles that will be processed over the rest of 2024. All credit has to go to our ICT team that restored the majority of our ICT environment in just over 3 weeks. I will now hand over to Richard Stewart to take you through the results of the SA region. Thank you.
Thank you very much, Charles, and again, good afternoon, ladies and gentlemen. We'll work through the regional operating updates. Thank you. I guess just to kick off with our first and last priority is safety. I think it's been very pleasing over the last few years, as we have shared with the market. We implemented a fatal elimination strategy in 2022, and I think it's been very pleasing over the last few years to see the positive impact the strategy has had in reducing risk across our operations. Over the current period, we saw our best ever serious injury frequency rate and a continued decline in the high potential incidents that we measure across our operations. These are all leading and lagging indicators that suggest that high energy incidents, which can result in fatal accidents, are being mitigated and reduced on a sustainable basis. Despite that, tragically, we did have a significant improvement year on year, but tragically still lost 3 colleagues during the reporting period. We lost a colleague at our Beatrix operations, Kloof operations, and Bathopedi. And on behalf of the management team and board, our sincere condolences go to our lost colleagues. Over the past 18 months, and in particular in the South African region, we have undertaken a significant amount of restructuring of our operations, specifically to position ourselves for sustainability in the current price environment we find ourselves in. Across South Africa, that's included the closure of unprofitable operations. That's included 4 shafts that we've closed and 2 processing plants. We've also restructured operations that were marginal. That included the Marikana Roland shaft and the Rustenburg Siphumelele shaft. And then to meet that downgrade in terms of production or restructured production, we also have restructured our regional overheads and services to align with that new operating footprint. We used the opportunity of the restructuring to introduce a new operating model for services in the region. We no longer have separate teams servicing gold and PGMs, but rather a single central services team providing services to all our operations in the region, which we certainly believe will introduce increased efficiency and effectiveness to our operations, bringing revenue benefits. This has been a significant restructuring. In total, since the beginning of last year, we've seen our total employee base, which includes contractors, declining from about 82,000 employees to just under 70,000. That is a total reduction of about 15%, and in line with the reduced operating footprint as a result of the restructured shafts. Of course, this restructuring has been highly disruptive to operations and does come with a cost. Most of those costs have been incurred now, with the final costs to be incurred during the third quarter of this year. And we then look forward to seeing the full benefits coming through in the years to come. The estimated savings from the restructuring in the South African region is about 3.5 billion Rand per annum, and that's measured against a cost base of 2022. And we expect to see the full costs from the final restructuring that was completed in June of this year coming through by the end of the year. We have also undertaken significant capital reviews, and in that regard have made a decision to delay the Burnstone capital and place that project essentially on care and maintenance in the current environment. The table on the right, we have presented something similar before, and this reflects updated numbers based on the actual savings realized. And as can be seen, gross savings from operational restructuring is currently sitting at just under 5 billion per annum. And when we consider the capital deferrals that are included in that on an annual basis, we're looking at a total saving of close to 7.5 billion per annum. I think despite those significant disruptions through that restructuring, the South African PGM operations delivered a solid and steady performance. Total production for the half year came in at just under 880,000 ounces, which is 4% higher than the equivalent period last year. The market will recall that we acquired 50% of Kroondal from Anglo during the fourth quarter of last year, and that added just under 70,000 ounces for the current reporting period and more than offset the losses from restructuring and shaft closures across the rest of the PGM footprint. Our production was negatively affected by a shaft bin failure that we suffered at Siphumelele that put that shaft out for almost 2 months, and then the legal industrial action that we had at Kroondal, specifically at our K6 and Kwezi shafts. Adjusted EBITDA came in at just under 5 billion rand, and although that is a significant decline year on year, that is primarily driven due to the much less 28% drop in the total basket price. But I think pleasing is that we have maintained our capital investment into our operations year on year, with a total of 2.55 billion being spent during the current reporting period, and I think testament to our sustained investment in our assets for the future. All-in sustaining cost increase was disappointing at 9%, much of that driven by the one-off costs associated with the restructuring, as well as the closure of the Klipfontein open cast at Kroondal. Taking off the one-off adjustments, what we tended to see is an increase of about 6 to 7% in the fundamental underlying costs, which is broadly in line with inflation year on year. I think worthy just to highlight that Kroondal did deliver its last ounces into the purchase of concentrate agreement with Anglo during August. And as from the 1st of September, that means Kroondal will now be on a toll processing agreement similar to Rustenburg. This will result in Kroondal's costs increasing, but also the total revenue increasing in terms of getting 100% of basket prices. Net, that does give us a positive margin gain for Kroondal as we move from a POC to a toll agreement. Gold operational output was a little bit disappointing. Overall, we saw a decline of about 17% year on year to just over 10.7 tonnes of gold produced. A significant portion of this was due to the closure of Kloof 4 shaft, which was finally closed earlier this year, and that did account for about 7% of the total decline. We did experience some increased seismicity, specifically at Kloof and Driefontein. And in addition, we did suspend some wide reef mining operations at Beatrix, where we suffered a fall of ground in a back area, where we stopped production to investigate the mode of that and understand the implications going forward. I think very pleasing is that Driefontein returned to normal production during the half, and by June was back at expected levels. Driefontein has significant flexibility to deal with the seismicity, and we are looking forward to that sustained production into the second half of the year. At Beatrix, we have instituted a new mining method for the wide reef areas, and by the end of the first half, 2/3 of those had been brought back online, and we expect the last portion to be brought back online during Q3. So we look to Beatrix to return to steady state levels by the end of Q4. At our Kloof operations, with the closure of Kloof 4 shaft, we have had a reduction in terms of the total flexibility, so the seismic impact there was significantly greater. In order to address this, we are increasing flexibility and opening up mining areas on secondary reefs, lower grade reefs, the Kloof Reef, as well as investigating other high grade areas. And this will be a process that's undertaken during the course of this year. We do, however, expect Kloof to maintain current levels and therefore below optimal output for the balance of this year. As a result of the decline in production, all-in sustaining unit costs were 18% higher. That is driven by volume, our total absolute cost base at gold had in fact decreased by 3% with the restructuring initiatives, which year on year, taking into account inflation, is about a 10% real discount in terms of those costs. Adjusted EBITDA, despite the challenges, came in at 2.2 billion. This accounts for almost a third of the group EBITDA, and I think is testament to the benefit of having gold in the portfolio during these macroeconomic challenging times. ERD contributed just under 2.5 tons of gold to the total output at an all-in sustaining cost of about 930 Rand per kilogram. And finally, our gold wage agreements that expired toward the end of June of this year, and we are currently in final negotiations with organised labour across our gold operations. Thank you, and I'll now hand over to Mika.
Thank you, Richard. In Sandouville, we have had focus on two things mainly. First of all, reducing the losses. Secondly, building up the future through our Gallican project. We have been rather successful in reducing the losses in Sandouville. H1 is clearly less losses than it was last year. There is a 57% improvement. However, we are still loss-making. And therefore, we have also decided that with the current feed and with the current products, we are going to stop the production. It means that there will be no more feed after the year end, and we are ramping down consequently Q1 25. Gallican is moving forward, and it is a project which is now in the pre-feasibility study phase. And we believe that we are going to finalize that by the year end. And then we are going to do the decisions about the definitive feasibility study and a possible demo plant in Sandouville, provided that the results are as encouraging as they have been so far. The good news are that we have actually produced PCAM in our lab, and our innovation is working through the chlorine route. Secondly, we have also patented this one to protect ourselves. So we see a good future for Gallican process, and the next time we can tell you more about it is definitely when we have the results out of the pre-feasibility study. Coming to Keliber. Keliber is moving forward, and there are no changes when it comes to commissioning the refinery H2 2025. You can see from our capex number, the latest forecast for this year, it has been changed from 360 to 300. And we are in some of the installations a bit late, which means that the capex is going to be spent on the next year's side instead of this year's side. But the commissioning of the unit H2 25 is still valid. Some milestones. The project is now fully funded. So we have a 500 million green loan secured in August. And we got very good support from the European Investment Bank, Finnvera, and a consortium of leading banks. And it confirms to all of us the strategic importance of this project, not only for Sibanye-Stillwater, but also for the European Union and European customers as such. For the future, we have also done exploration. So we have some really good results on that one. And obviously long term, we all want to see growth. And we know that there is a strong demand of lithium. So we continue that work in parallel with the construction of the sites. Now I want to show you some very beautiful pictures from Finland. You can see on the left-hand side, you can see two pictures of the refinery in Kokkola. That construction is the most advanced of the 3 places where we are doing the construction. You can also see that actually in Päiväneva, the concentrator is moving forward as well. And even the Syväjärvi open pit mine site has started well and really ready for, first of all, with the external spodumene feed starting the commissioning for the refinery H2 25, but with our own ore towards the very end of 26. And over to you, Robert.
Thank you, Mika, and hello, everybody. The Century operations again had a very tough start to the year. They received about 1,100 millimeters of rain in the first 3 months of the year. This compared to a historic average of about 550 millimeters of rain. That said, I'm pleased to say that the lessons learned from last year and the rain protection precautions the team put in place still enabled them to produce 16,000 tons of payable zinc in Q1. The operations recovered very nicely in the second quarter of the year. They produced 26,000 tons of zinc. So all in, we have produced 42,000 tons of zinc for H1 2024. It's very difficult to compare the first half of this year to the first half of last year, as we didn't own these operations for the first half of last year. But I can tell you that Q2 this year, the production was substantially better than Q2 last year. Our all-in sustaining costs improved by 8% to $2,228 per ton of zinc compared to the same period last year. This largely due to improved production, but also in part due to very tight cost control measures the team on the operations have introduced. Our EBITDA loss has reduced from 28 million in H1 last year to 19 million in H1 this year. A substantial portion of that 19 million is directly due to the 5-yearly maintenance of our transshipment vessel. I can confidently report, though, that all of our deliveries will be filled before the end of this year. In conclusion, I am looking forward to a good finish to the end of this year. I'm looking forward to a good H2 2024. And in fact, I'm looking forward to a good 2025 as well. In part, assisted by 2 tailwinds at the moment. The first being metal prices are substantially more than we anticipated and better than what we budgeted for. And spot treatment costs are also lower than the current benchmark spot treatment costs. You can see on the slide that we have hedged approximately 20% of our production for the next 18 months. So that is about 2,000 tons per month of payable zinc from July of this year through to December next year. So I think I will leave it there and hand over to Charles. Thank you very much.
Thank you, Robert. As we turn to the Americas region, what you'll see in these results are the benefits of the restructuring we did late last year. We had a 16% increase in mine PGM production to 238,139 2E ounces, which is the highest production rate since H2 2021. We also had a 23% decline in all-in sustaining costs to $1,343 an ounce. Operating unit costs remained stable at $1,067 an ounce, despite inflation year on year, which was due to improved production. Both production and costs were ahead of plan, and I want to recognize our operating teams for that strong performance. Ore reserve development was 42% lower at $65 million, and sustaining capital 51% lower at $21 million, a combined saving of $68 million. Project capital declined by 63% to $8 million. However, during this period, the average 2E PGM basket price declined 30% to $977 an ounce, which has now led us to take more significant restructuring steps that I'll talk to in a moment. Adjusted EBITDA of 27 million, as you are aware, includes 43 million US insurance payout from the 22 flood. As Neil has outlined, with a PGM basket price below $1,000 an ounce, we are now needing to do further restructuring in our Montana business. This will see us reducing next year's production by approximately 200,000 ounces, or some 44% of current run rates. We are doing this by placing the Stillwater West mine on care and maintenance, while keeping Stillwater East going, where we intend to increase production to approximately 130,000 ounces next year. At East Boulder, mine production will be reduced to 135,000 ounces. We will be mining 4 ramps instead of the current 6, which in turn allows us to defer expansion capital in the tailings and rock dump facilities. We are also reducing fleet at both operations, which will have a number of cost and resourcing benefits. This reduction in mine ounces should see us reducing absolute dollar all-in sustaining costs by some 41%, or approximately $385 million on current projections. Our total capital for next year will more than halve to some 29 million. Neil has highlighted the significant reduction in headcount, which will see our employees' numbers reduced by almost 40% as we align hourly and salaried employees with the revised production profile. As part of this restructuring, we are collapsing our current dual management structure across 2 mines into one new structure, reducing some layers and moving select management functions to the center to service all business units. We will also further reduce our contractors and backfill these roles with our own employees where possible. We will also make a number of changes at our Met complex, but retain sufficient scale to support our PGM recycling operations. Importantly, at all business units, we will retain the optionality to return to higher production as prices permit. This restructuring is not just about reducing volumes and people, but critically, it's also about improving operating efficiencies, ongoing cost reduction, and throughout preserving the optionality of these high-quality, long-life ore bodies at both mines. With this restructuring, we are also initiating a new vision to drive towards a sustainable business through the price cycle for the long term. Let me characterize key aspects of this vision for our Montana business. First, a key foundation for all the changes required to create this vision are engaged employees committed to delivering world-class outcomes. Obviously, with the restructuring of the scale, we run the risk of losing significant talent and undermining team morale. But I do believe that as we deliver the necessary changes to make this profitable, we can make these operations a rewarding place to work for the long term. Second, we want to continue our best-in-class ESG performance. An example of this is that we have just received the record of decision for a dual federal and state environmental impact statement for our East Boulder tailings and rock storage expansion. This follows a 3-year, 9-month process with no legal challenges and with the final decision issued with no objections, both of which are unprecedented in mining permitting processes in the US today. This speaks to the integrity of our stakeholder engagement and our collaborative relationships with environmental and community NGOs. It's also a testament to a robust regulatory structure in Montana, where an independent review panel must sign off on all new tailings facilities. Last but not least, it talks to an exceptional environmental planning and permitting team in our Montana business. Obviously, with the significant restructuring announced today, many of these relationships with our diverse local and regional stakeholders will likely be stressed, but I believe that the integrity with which we conduct these engagements will ultimately prevail. And the test of any partnership is to be able to have open and honest conversations, especially in challenging times. Another key aspect of our vision for this business is to drive our all-in sustaining costs to $1,000 an ounce, which we believe we can achieve over the next 3 years, primarily with a focus on ongoing cost optimization. We will focus on optimizing and resource loading the current mining front while introducing task mining as appropriate. On mining methods, we want to fully mechanize cut and fill, and convert to sub-level extraction where possible at both operations. As mentioned, we will fully optimize fleet requirements, and we also intend to improve shift execution and blast cycles, which will be a key parameter to get better efficiencies and cost outcomes. Throughout this process, we are introducing a digital twin for enhanced planning and more strategic look at how to optimize these operations. While scaling back production in the short term, we believe that we can also use this time to properly reposition these operations for improved future performance. This is especially true at Stillwater West, which, as noted, we are placing on care and maintenance. But we have work to do here to ensure that when that operation restarts, it does so with improved underground infrastructure and efficiencies. On all of this transformative repositioning work, we will need to work collaboratively with the United Steelworkers to find new pathways to improved efficiencies and operating flexibility. This is an important partner for us, who we firmly believe can help us create a long-term sustainable mining business that is world competitive. In concluding, let me note that we are uniquely positioned as a leading US critical minerals PGM miner and recycler. The steps we are taking today will position this business for a sustainable long-term future that is important to the US critical minerals self-sufficiency agenda. As I hand over to Grant to take you through recycling, let me just note how proud I am of the work that he and the Reldan team have done to integrate this and industrial scrap business into our Americas platform in a very short period of time. You will see the first glimpses of this impact in these results as we now introduce gold, silver, and copper to our Americas business. But I also know that the embedded growth potential of this enlarged metals recycling platform is significant, and it is only a matter of time before you as owners and analysts will start to recognize this in Sibanye-Stillwater's valuation. Thank you, and let me hand over to Grant.
Thanks very much, Charles, and good day to you all. Yes, important to note that the Columbus Recycle business remains largely unimpacted by the restructure. We will continue to receive material and differentiate ourselves in the market through our positioned approach to responsible sourcing, our strong assay turnaround time capability, and our long-term relationships built on experience, knowledge, and trust. Despite the sustained macroeconomic pressures on spent autocat volumes, the US PGM recycling business remains solid, with volume stabilizing at around 155,000 3E ounces. Gross margins have remained stable at between 4 to 5%, despite the 54% decline in 3E prices from the first half of 2023 to the 1,252 that we have received this year. The PGM recycling segment contributed a solid $8 million, that's 147 million rand in adjusted EBITDA for the first half of 2024, again underscoring the strength and stability of our operations. In mid-March of this year, we also concluded the Reldan transaction, marking a strategic milestone in our recycling strategy beyond our traditional focus on PGMs from autocats. We have expanded beyond solely relying on PGMs from spent autocats and tapped into high-margin industrial waste streams, which open up new avenues for growth. Reldan specializes in processing industrial and electronic waste, offering a significantly less capital-intensive alternative to traditional mining operations for producing a suite of green metals. From March to June 2024, Reldan processed 6 million pounds of mixed scrap and sold 42,000 ounces of gold, 850,000 ounces of silver, just under 15,000 ounces of platinum palladium, and 1.1 million pounds of copper. The resulting combination of Columbus and Reldan industrial and precious metal suites presents a natural hedge, reinforcing the sustainability of our business model. The acquisition further enables us to leverage Reldan's networked sales team and metal logistics routes to capitalize on existing territories and relationships within the US, Mexico, and India for the benefit of the Columbus Met complex. Reldan's strong early performance contributed $300,000 in adjusted EBITDA and adjusted free cash flow of $9 million for the initial 4 months under our ownership. Having recently visited both operations within Mexico and India, I'm deeply excited about the growth prospects in both of these regions. So please watch this space. Neil, over to you for the conclusion. Thanks.
Thanks, Grant. And 2 slides in the conclusion. The first slide is really about guidance. And let me say, other than our South African gold operations, which have been severely disrupted through the restructuring and seismicity, we are having to adjust guidance, unfortunately, on that. The Keliber lithium project, we won't quite spend all the capital we intended this year, so the revision is really a revision in spending. There's no other revisions to that project to date. We are not changing the US guidance, but I do want to say we should expect significant, there's the potential for disruptions due to the restructuring that we hope to have completed by the end of the year. But I think that is just a bit of a warning or a heads up. So the anti-fragility journey continues, and in my mind, the key aspects of becoming anti-fragile are the bullet points set out below. So first of all, let's recognize the record safety performance that has been achieved with a continuous focus on eliminating fatalities and reducing high potential incidents. As I mentioned right at the beginning of the presentation, ESG will remain embedded in the way we do business. We think it's appropriate, and it leads to sustainability. As I also mentioned right at the beginning, diversity, equity, inclusion, and belonging will remain an integral part of our strategic differentiation. The fundamentals, as elaborated on by Richard and Mika, indicates that from the metals we produce, we have exposure. We remain positive regarding that exposure. We've also shared with you significant strengthening of the balance sheet with more non-debt initiatives well advanced, and we look forward to including those when we deliver our year-end results. We have sufficient liquidity to ride out an extended depressed commodity price environment and progress our key projects should that depressed commodity price environment occur. We've taken decisive steps to optimize our operations for the short and medium term, and Richard shared with you the very impressive amount of savings that we are looking forward to from that. There was a strong performance from our South African PGM operations. There are operational improvements expected from South African gold in the second half of this year, and clearly we hope that's sustainable into 2025. Unfortunately, the US PGM operations enter a new phase of restructuring for the current lower price environment to reduce the cash flow outflows and preserve optionality. Again, I want to say it means we are taking 200,000 ounces out of the market over 2025, and that will probably be ongoing. We are working towards a cost structure of $1,000 an ounce over a 2 to 3 year period, and our integrated global recycling footprint, which spans autocasts, industrial and electronic waste, is very well positioned for growth in key regions being the US, Mexico, and India. So bottom line, we're exposed to the right metals and ecosystems, very importantly, at the right time. And we look forward to a much better future in terms of improving commodity prices and profitability. With that, I will hand over to James to pick up any questions. Thank you, James. Over to you.